My name is Michael King, and in this video we're going to be looking at capital budgeting, focusing on capital expenditures and how to evaluate them using payback and discounted payback. In the textbook by Booth, Clear, and Rikita, this is sections 13.1 and 13.2. So you may be wondering, how does a company identify which investments are going to be profitable? Where investments are called capital expenditures, and that could be the purchase of new equipment, could be the purchase of software, or the purchase of another company. The process of deciding between different capital expenditures is known as capital budgeting because it involves deciding where to allocate the capital that's been raised by issuing debt and equity to different projects. We're going to be using the same time value money tools to evaluate between different projects. Capital expenditures can be either tangible, meaning they're going to be fixed, such as property, plant, and equipment, or they could be intangible, such as copyrights, trademarks, or brand names. CAPEX decisions are critical for a company because they involve a lot of money. They take a number of years in order to generate a return. Once you start a project, they can be very hard to cancel, and sometimes they can affect the whole risk of the firm as well as its long-term viability. Capital budgeting is a multi-step process that typically involves the most senior executives at a firm. Those executives will be reviewing projects that are promoted or put forward by different parts of the organization, and they'll be looking at the investment alternatives, evaluating them, implementing those different alternatives, and then monitoring and evaluating them afterwards. A key point why this CAPEX decision is taken to the very highest levels of the organization is that they're critical for achieving a business strategy. So in the work of Michael Porter on 5 forces, we know that a firm will try to seek to have a competitive advantage, either by following a strategy such as cost leadership or product differentiation, but that it is very difficult to sustain this competitive advantage. Looked at differently from the point of view of investors, using a bottom-up investment style, may be looking at a firm simply as a group of different CAPEX projects or decisions, and may evaluate whether to buy or sell the firm based on whether they're making good decisions or not. Top-down, we'll also look at how projects or acquisitions will fit within the strategy that the company is promoting, as well as where it sits in terms of the overall economy. CAPEX will play a big role when trying to calculate the value of a firm using a discounted cash flow model, because a CAPEX is a use of free cash flow to the firm. When you ask CFOs and CEOs what they use to make these capital budgeting decisions, they will often choose NPV as well as IRR. We're going to be talking about both NPV and IRR in a subsequent video, and today we're going to be talking about payback as well as discounted payback, and later we're going to talk about the profitability index. So let's look at a simple example to try and understand how to use this, and we'll follow this example through with first payback, modified payback, then NPV and IRR. Assuming you're a company that's going to purchase a computer system with an upfront cost of $150,000, which you'll be able to sell after 5 years for $40,000. Each year that you have this computer system, you're going to save $50,000 or $250,000 over 5 years. Now, if your hurdle rate or desired return on your investments is 9%, the question is this a good investment? Another way of putting this is, it may seem obvious, but is this a good investment? And keep in mind that companies often have many different investment opportunities but limited capital. So another critical question is this a better investment than other alternatives? So payback is a way to look at the upfront cost and compare it to the cash flows. So in this case, you'd be looking at $150,000 that you need to recover. That's the upfront cost to buy this computer system. And you're going to be saving, or if you like, earning $50,000 each year from that investment. And so the payback is going to take 3 years, $150,000 divided by 50,000. Now, this looks like a good investment, but the question is that enough? Well, the problem with payback is that we look at the cash flows in each year, but we do not adjust for time value money. So the chart on the right shows you the cash flows from this upfront investment of $150,000 in year 0, the $50,000 savings each year for 5 years, and then the salvage value in year 5 of $40,000, and you can see the total cash flows in the final column. Notice that the payback is after 3 years. That's how long it takes to recover the upfront cost. The problem is that this method, payback, does not look at the cash flows that come in years 4 and 5, which we can see here are worth $140,000. Another problem is that payback is not looking at time value of money. It's treating cash flows in each year as if they have the same value. Payback does have its advantages. It's quick and it's preliminary, and it's useful to eliminate obviously poor investments, but it has many disadvantages. It only provides a measure of the time to recover the upfront investment. It doesn't take into account the time value of money or discounting, where cash in the future is not the same as cash today. And it may not be suitable for comparing investments with different useful lives because it doesn't look at any cash flows that happen beyond the initial repayment. So the bottom line is don't use it. There are better methods, and we're going to be focusing on net present value. Some people have tried to save payback by adding a time value to money dimension, which is called discounted payback. So rather than accumulating or summing the cash flows in each year until they meet or exceed the upfront cost, discounted payback will first discount each of those cash flows to find its present value in today's dollars, and then it will sum them to see how long does it take to recover the upfront cost. Okay, so let's take a look at that example. Here we can see on the left the regular payback has the outflow of $150,000 upfront, and then the inflows starting with $50,000 per year in years 1 through 5. And as we saw, the $150,000 upfront is recovered at the end of 3 years. However, the $50,000 per year is treated the same whether it's received in years 1, years 2, or beyond. With discounted payback, we're going to treat each of those cash flows as cash flow that needs to be discounted. So we're going to find the present value, and here we're going to use a 9% discount rate. And so on the right, all we do is we take the cash flows and we discount them for the appropriate amount of time. You can see that the cash flow of $50,000 received at the end of the year is actually worth $45,872, and that the $50,000 received at the end of year 2 is actually worth $42,084. Now look at the cumulative payback in the far right. We see that it doesn't become positive until sometime in the 4th year. At the end of the 4th year, it is a number of plus 11,986. Now, we can see that at the end of the 3rd year, it's still at 23,435 that has not been recovered. That means that sometime between the end of the 3rd year and the end of the 4th year, the full sum has been received. How do we figure out that amount? Well, what we're going to do is we're going to take the ratio of how much needs to be recovered at the end of the 3rd year and look at the cash flows that happen during the course of the 4th year. And you can see that there's 23,435 that needs to be recovered in present value terms, and that we receive 35,421 for the course of that 12 months of the 4th year. So we simply have to take the ratio, and we can figure out at what point in that 3rd year is the money recovered, and it is 0.66 of a year, or 0.7 rounding. And so adding that to the 3, we see that it's 3.7 years for discounted payback. While discounted payback does take into account time value money, what we're going to see is that it is not recommended. Instead, we're going to use net present value.